Good day, everyone. Today we have a very special guest, Mr. Aashish Somaiyaa, who's currently the CEO of WhiteOak Capital Asset Management, which is the erstwhile Yes AMC. He has over 21 years of experience in the asset management industry. And previous to his current role, he has been the CEO and Managing Director of Motilal Oswal. And he also has worked at ICICI Prudential. He holds interestingly, he holds a Bachelor's of Engineering in Polymer Science. And he has a management studies, a Master's in Finance from Narsi Mohanji Institute of Mumbai. Ashish, welcome to our chit chat.
Yeah, hi. Thank you for having me. Thank you. It's my pleasure.
Ashish, so let's start off with the announcement that came last week, which I think probably is the right time to talk about. You actually have acquired the erstwhile Yes Asset Management Company and have rechristened it as WhiteOak Asset Management. So this is your entry to mutual fund industry from a PMS / AF provider. Can you briefly tell us about the thought process behind it and why you went through an acquisition instead of applying for a license directly?
Yeah, so thought process is basically straightforward. That WhiteOak Capital actually was founded by my colleague Prashant Khemka in June 2017. And before founding WhiteOak, Prashant used to be with Goldman Sachs for about 17 years. He was the chief investment officer and lead portfolio manager for their India equity as well as for their global emerging markets strategies. So after he founded WhiteOak Capital, for the first 4 to 5 years of our existence, we have been, one of our group companies is an asset management company registered with Monetary Authority of Singapore, based out of Singapore, of course. And we also have a group company, which is an asset management company in Mauritius. And of course, before this acquisition in India, we were always licensed as a portfolio manager and an investment manager to alternate investment funds. Of course, all of this is total of about $6 billion, which is invested into listed Indian equities. And my colleague Prashant has a very interesting way of putting it that, if you're passionate about playing cricket, then there is no reason why you will not play all formats. So whether it is T20, one day or test match. Now, not exactly alluding to the speed or way of playing, but purely from an investment management perspective, if you want to target the wider base of Indian customers, if you really want to provide your services to retail investors, then mutual fund is the format to go. So that's why we were always keen to, set up an asset management company which would offer mutual funds to retail customers. As far as going acquisition way versus, applying for a license, I think, if there is an asset management platform which is available and you qualify to buy that platform, it just makes your entry, relatively, nothing is easy, just makes it relatively easier or faster because there are already, regulatory approvals, the people, the platform in place. So I think it's just about, getting there in a relatively, nothing comes easy or fast, but it's just more relatively quicker to, get to market.
Great. What are your thoughts? So PMS, AF, these are all high net worth investors, right? 50 lakh, 1 crore. And so they're, I'm again asking you, are they a little more discerning about the market's upswings versus now that you are in proper mutual fund, you're going to get small SIPs starting from 500 rupee to 5,000. So retail investors probably perception about market ups and downs will be a little different. How are you going to address and what are your communication strategies to make sure that they stay the course, not just be there for a bull market or a bull run?
So I think look, broadly speaking, even if people are investing in relatively smaller tickets in a mutual fund, so there's nothing to say that people who are retail investors can withstand market shocks, less better than people who are supposedly savvy high net worth investors. In fact, in my experience in both camps, there are both types of people, because I've seen enough and more number of retail investors in my previous experiences. I've seen enough and more number of retail investors who are reasonably diligent, reasonably disciplined, who go by the book, who follow all the inputs and the advice, and they remain invested irrespective of market-related, challenges. On the other hand, I've also met and spoken to and dealt with HNIs who redeemed at 12 noon on 23rd March 2020. So both of those things I have witnessed actually. And I think it's just that, yes, but that is more about examples. But on an average, one does expect that people who are high net worth investors have a larger corpus to invest. It's just that maybe their ability to tolerate financial shocks, or maybe their ability to tolerate, because potentially the investment surplus might be of a higher magnitude, and they might be able to dispose of that surplus towards growth objectives. Hence, you assume that their ability to withstand shocks will be a bit more. That's maybe on an average, but I think there are all types of experiences that one has.
Good insight. So thanks to the pandemic, one of the good upshots is we have seen a huge uptick in terms of demat accounts being opened. I think last I read it's about 30 million plus. So do you see this as a trend that's going to continue? And are you uniquely positioned now as an MF fund house to capture the coming generations, who are going to look away from, let's say, the traditional Indian investment of gold, real estate? What do you think were a couple of reasons for this trend, and what are your insights on what's going to happen going forward?
So my own sense is that COVID-related disruption, and there are three facets of the COVID-related disruption. One facet is the fact that not only COVID actually, because of demonetization itself, but there are two facets which are related to demonetization and thereon. Like one facet is of, structural decline in interest rates, and very poor returns from all fixed income investment alternatives. And even, all small savings, bank deposits, savings rate, everything, if you see, demonetization was one floor, and then during COVID it went even further lower. I think in COVID is the first time we started hearing of savings rates at 2.5% and stuff, right? And I think demon was the first time we started hearing that 1 year FD rate can be 5%. Today if I see the entire fixed deposit yield curve, it just doesn't go beyond 6.5. If it is senior citizen, then maybe a few basis points more, but basically the FD list ends at 6.5. It was not like that in the past. So that is one facet. Second facet is related to demon as well as COVID is you're forced, whether it's a payment app, like what happened with demon. Anybody and everybody had to be on a payment app. What will you do? You have no alternative. Cash was not there, right? Everybody had to bung in money into the bank accounts, and everybody had to be on some digital interface. And then COVID only accelerated. So structurally lower interest rates, high liquidity, savings as well, and you're forced towards digital adoption. These are both things. The other important thing is that there was a lot of noise about the stock market really in general, after COVID, because 40% fall itself attracts a lot of attention. And I think sequentially what happened interestingly was that the US market tanked first, and then, all the NASDAQ and all these stuff. So I think generally social media penetration, media influence, a lot of noise on the market, digital interface, a structural collapse in all alternative investment options. So confluence of multiple factors. That is, but what happens? Some of these are 1 year, 2 year, 5 year micro trends. But then look at what is happening structurally in the background. Structurally in the background, like, there is a famous adage that habits change with generations. So structurally in the background, any which way, generationally, if you see, my mom's generation, for instance, I always do this thing when I am talking to a large audience. I always ask them that if I say the word interest rate, what number comes to your mind, right? Our generation or my mom's generation used to think that, boss, it is 11% or something. Like I used to, if you ask me interest rate, somehow in my head it is 8-9%. But And in off late, a very famous bank plastered the whole world with 4% and 6% and stuff, right? So what does the word interest rate mean to you? That number has changed dramatically in last 20 years. So the long trend is that people have to move towards capital markets. But within that, there are a couple of things which have happened which accelerated that move. I think this is not going to reverse.
Excellent. We have seen a slew of new age AMCs come up with indexing as the flavor, very low cost funds. And I believe a lot of other PMS funds have also applied for an MF license. And there are entrenched players with good distribution network. Being a bank plus an AMC has its own advantage, right? And you have been part of ICICI and other well-known AMCs. So you know the distribution bottleneck that any new MF faces. I know it's too early. You have just announced it last week, but what are the strategies that you plan to make sure that it's not restricted to the top tier cities or 30 plus? What are your strategies to expand it beyond the 30 plus cities?
So we will be old world and new world, in the sense that we will be physically present as well as we will obviously be part of the digital ecosystem. So our game plan is to be actually in all the B30, like say, for example, if you ask me next 24 to 36 months, our sales head and my team can throw better light, but 85 to 90 locations with over 110 to 120 branches, plus presence in the all digital interfaces. So our plan, our strategy is and, it's not or. So that is one. On your question, if you ask me, you did mention that there are many questions in what you said, which is that there are some AMCs which are banks with asset management license, and there are some which are fintechs, who would like to have low cost passive kind of products. So what is unique about WhiteOak is that, it's one of the few times, or probably the only time, where a professional fund manager has got license to launch an asset management company and manage it. So see, we are not a broking company, we are not fintech, we are not insurance, we are not a bank, we are not an industrial conglomerate, we are nothing. It's just I have been a professional CEO for last 9 years. Prashant has been a professional portfolio manager pretty much for 24 years actually. So we have no background other than professionals coming together. Of course, he's the founder, he hired me, but basically we all are professionals, we have no other background. So everybody has their own narrative, right? If you are a large asset manager, you will say that brand and distribution is very important. If you are a fintech guy, you will say, cost is important and people buy only digitally. If you are in my shoes, you will say it's all about fund performance and fund management capability. I think there is none of these narratives is wrong. It's just that you will have your strength and you will have your competency and focus areas, and you will lead with your competency.
Nice way to put it. You will let the numbers and the performance do the talking than anything else. Excellent.
I'm just saying that, look, performance is also something which is an effort, which is an outcome of some inputs, like, consistency and quality of inputs, process, research. So you put all those inputs and, all said and done, we are in the equity market. Whatever we may say, we don't really control outcomes. We are dealing in variable outcomes. So when you're dealing with variable outcomes, the only thing you can control is consistency and quality of inputs. So by claiming performance, it's not like we'll get performance because we claim that we'll get performance. But everybody will have their own, competencies, and everybody will have something that they would like to lead with.
You mentioned your process, process-driven company. What is the unique investment framework or the approach that WhiteOak follows in picking individual stocks, or just generally, if you can broadly tell us about your unique research or investment process or framework?
So, interestingly, you will find that most managers have a style. They lead with a particular style, either it's quality, growth, value, contra. So people have certain style. Then people have certain filters and screeners, that these are the kind of companies we go with. Now, after 20-22 long years, my learning in the industry is that when you have a style, right, that style helps you generate outperformance over the benchmark. But when you have a style, you also end up with a lot of factor tilts, meaning that, if you're growth oriented, see, look at this way, 2006, 16, 17, 18, long period, growth oriented styles did well. 2019-20 only quality worked. 2021 there is a big rotation in the market. If you're a value kind of guy, value unlocking, PSU, metals, infrastructure, that did well. Then 2016-17 small and mid caps did well. 2018 till mid 2020 it was completely out of fashion, and then suddenly small and mid caps did well. So whether it is sectors, whether it is segment of market cap, or whether it is style, if you have preference of any kind, it exposes your portfolio to certain tilts. And market by nature will rotate. When macros change, markets will rotate. So styles go in and out of favor. So if you're very, very style biased, you will have significant outperformance, and it might be followed by underperformance. So one of the things at WhiteOak is that we pay a lot of attention to portfolio construction. So we run balanced portfolios, and we don't start any conversation by saying we are value growth. We are basically open-minded. That is first. Second is that we look for 3 or 4 things. One is we look for high governance companies, no doubt about it. So we'll not say that at a price anything is good, or at a price everything is good. No, that's not the camp we are in. We are basically looking for high governance companies. Second thing is we'll always value companies. We have a proprietary or a trademarked valuation framework called OpCo-FinCo framework. In short, basically it is our own valuation framework whereby we look to identify companies which generate free cash flow over and above cost of capital. Or we value everything on free cash flow basis. We value everything for excess return produced over and above cost of capital. And we'll do a DCF for everything basically, right? And the third thing which is very important for us is that we will look for companies which have a scalable long-term opportunity. So, if there are, say, for example, there are many businesses where it is very difficult. When you do a DCF, a lot of the value resides in the terminal value. So if you have no visibility or no future, if you don't have a sustainable or a scalable opportunity, then very difficult to visualize. So we'll not buy something because it is undervalued right now and it can give us a pop in the next 1 to 2 years. We'll look for scalable long-term opportunity. So these are few options. And I'll repeat these, these are the few parameters that we look for. And I'll repeat what I said in the beginning, which is that, when you listen to a lot of the discourse, it makes you feel that stock picking is everything. Of course, stock picking is important. But, so stock picking is important for fund management, but fund management is not just stock picking. That's why I started by saying that we pay a lot of attention to portfolio construction, because we would like to generate significant outperformance and consistently, not like go through swings of outperformance and underperformance.
From investment style to your personal management style. At the beginning of our conversation, I noted something. You are a polymer science engineer. You're very rarely have I come across anyone who has transitioned to managing finances. So over 2 decades, how did you start, and what has been your management style, and what have you picked up along your journey? A little bit about your management style and experience.
So I think, so first is, it's a very common conversation, because there are many students, many youngsters also who do listen to conversations. I was recently asked that, does it help being an engineer? Or, I personally think that, for example, Charlie Munger has this very interesting way of saying it, that, to be a good investor, you need to have a lattice work of mental models. Like you need to have, or, you say that, you need to have thinking in metaphors, for example, or, thinking in terms of different frameworks. I think that has helped a lot, because I can tell you one thing that, a lot of financial concepts are easier explained if you use the sciences. I'll give you the most common refrain. If, when the market tanks or a stock tanks, when 100 becomes 50, it's 50% down. And you must have seen it a lot of people say that, when it goes down, if 100 becomes 50, it's 50% down. But for recovering, now you need 100% rise. And this scares the hell out of people. Now that's a psychological play. If you remove stock prices and if you remove the index, because even in stocks and the index, there is a price, but there is ultimately earnings of companies that you're talking. If you remove that and you think of a spring which is storing kinetic energy, you think of it logically, that a 10 centimeter spring, if you compress it by 50%, it becomes 5 centimeters. If you release it, it will recoil 100%. It will not recoil 50%. Right. So that's one way. Like, for example, if you ask me, asset allocation is closest to chemistry, because different matters or different materials come together. But when they come together, they are supposed to lose their individual properties. Like if you put gold in a multi-asset portfolio, it's not supposed to behave like gold individually. It's supposed to behave like the sum total portfolio, right? So I think being an engineer has definitely helped me to think, like, when interest rates go down, bond prices go up, but long bonds go up much more. That's closest to the principle of leverage, actually. Right. So I think I'm just giving you 2-3 examples, but I've written many articles on, these metaphors or, thinking, through a different framework. There's a very interesting book written by a gentleman called Roger Hagstrom, which is, Investing the Last Liberal Art. That whole book is about applying different sciences to investment management. It's very interesting. Like companies, for example, like evolution says survival of the fittest. How does it apply to companies? Those kinds of things. So I think that has definitely helped. In terms of style, if you really ask me, it has been one big ride because, for example, I've had a couple of times in my career, I've had a coach helping me because, I had many years back, I used to have very individualistic style of operating. And I don't think that I have been like a natural reader, really. I think I have been coached and groomed and, thoda left, thoda right, being directed in a certain manner.
Very interesting, how portfolio composition in terms of chemistry and the lattice work of mental models. Beautifully explained. I think probably this is going to be the highlight of our interview. Let's talk a little bit about the last 2 years, the kind of paradigm shift we have seen and structural changes. Ashish pre-COVID and Ashish post-COVID. What has been your big learnings and transitions and what are your key takeaways of this 2 years?
Yeah. So 2 or 3 things. One is that I think as you grow older, and plus of course these experiences that one gets, I think in the last 3-4 years, my biggest learning is all about being open-minded. For example, F. Scott Fitzgerald, who's a very famous American philosopher. He said that the test of a first-rate intelligence is to hold contrary views in your mind and still retain the ability to function. I think that is one of the key traits. Look, like I'll give you an example. I joined WhiteOak somewhere in August 2020. It used to be 25 to 26 employees. Okay, it is now 156 employees. And along the way, we have expanded our footprint domestically. We have acquired an asset management company. We have put a team in place to go ahead, right? We are operating from a 3,000 square feet office in Mumbai. Now we have offices in 10 cities and rising rapidly. Like I said, what our ambition is, I already told you. And from 3,000 square feet office in Mumbai, we now have 12,000 square feet. So, we've hired, we have grown, we've changed our HR policies. WhiteOak, for example, is fully flexi working. So people can work from home, people can work from the closest WeWork, or people can choose to come to office. So I think that it has been one major exercise in, unlearning, relearning, calibrating, taking 1 step or 2 steps at a time, but also not closing all your options. So I think it has been a great experience. Also interactions with clients, interactions with different stakeholders. I think there has been more depth, there has been more nuance. So very challenging time, but also very interesting time.
Challenging as well as interesting time. Thanks for that.
Yeah, I mean, if somebody told me that, would you like to short circuit this whole process? I would say no. I mean, I want definitely great to have this experience. Great to have run a business during the bad times. And then, I moved here in August 2020. By then, bulk of the crisis was in some sense over. We had lived through the worst by then. But even in my previous role, obviously we were managing huge equity assets. You can see that people are panicking. You need to handholds with people. You need to keep talking to them. So it's been a very busy 2 years, but then grateful for the experiences.
This is something that I ask every time I meet a CEO, and I see that you have a bookshelf right behind you, and I was just trying to pick out any books that I have read. Can you give us 3 top books that you would recommend?
Sure. Yeah, I love reading books. In fact, this is just part of what you're seeing. There's like around me, there's like a library. But one I already mentioned to you, which really helped me a lot. Right. But 2 or 3 more. Like, for example, I love this book by Adam Morgan, which says Eating the Big Fish. It's very, very important for anybody who is a business builder. See, if you're inheriting a legacy, that's different. But I'm very grateful for my experiences that I'm associated with starting or helping create a business, maybe second, third time in my career. So Adam Morgan's book, which is about challenger brands, it's called Eating the Big Fish. That I think is a big inspiration, great learning. The second one is, let's be honest, everybody goes to B school, but I don't think everybody reads. Everybody has read, Competitive Strategy, Competitive Advantage, Michael Porter, some 1,500 pages. So we all know what he says. But I think there was a book written by one of his disciples. Her name is Joanne Magreta. And she wrote a book called Understanding Michael Porter. I think that is a fabulous book. Then there is a book on, there's a book called Quiet, which is about introverts. It's written by Susan Cain. I love that book also. And then there is one more called Willful Blindness. Willful Blindness, I'm sorry, I'm somehow forgetting. I have read a couple of books from the same author. There is another one called Uncharted. Yeah, Margaret Heffernan. Willful Blindness. So I think these are some books. Then I even love Adam Grant. I love all his books. Like I like Give and Take. I like Think Again. So yeah, these are some good. I'm sure I'm missing few, but yeah.
I think this has been one of
I love Simon Sinek also, for example.
Simon Sinek, yes, of course. This has been one of the most interesting book lists that I have heard in recent interviews. You are a bookworm indeed. Like just before you close, so this is again something that I ask. What keeps you awake at night, and what gives you the motivation to wake up early in the morning? So 2 contrasting things. What is something that keeps you awake at night, and what is something that makes you look forward to?
See, I think in the last 1.5 to 2 years, specifically 2 years, this whole pre-COVID. See, we have been in very tough environment since 2018, right? In our industry, for example, a financial services entity like ILF is defaulting, and all the structural challenges that came after 2018. Look, COVID is one, but I don't think most of us had even seen 4% GDP growth with practically zero corporate growth. And we all are engaged with the stock market, but last 7 to 8 years has been very, very difficult. So, building a business, engaging with clients, being in the stock market in all these years, I think last few years have been challenging. But specifically in the last 2 years, a lot of my orientation has changed in the sense I think a lot about what my employees think about, what my colleagues and what the team thinks about how we are conducting ourselves. Previously, I was always very preoccupied only about, stakeholders, customers, the external environment and stuff. But last 1.5 to 2 years, I think mostly to do with COVID. I think I'm more worried about what do employees think and what they are experiencing and how things are going for them. Because your ability especially, when you are creating a new organization, when so many people are coming together, there are so many constraints in terms of how you relate to people, how you communicate with them. You're not like meeting everybody every day. So how are employees experiencing this whole thing? What their concerns are? How comfortable are they? How do they feel how they are being treated? When you say something, how is it being received? What is their mental makeup, or in what frame of mind are they? Because, so many of the contexts have changed. So yeah, that's top of mind for me. Otherwise, there's not much that keeps me awake, really, honestly speaking. I'm not someone who loses sleep too easily. But yeah, this is what I've been, just top of mind, this is what I've been thinking about.
Excellent. Thanks, Ashish, for taking your time out and speaking with us. Some great insights, some great book recommendations, which I'm sure the next thing, as soon as we are done with this interview, I'm going to buy all the books that I haven't read already. And wishing you all the best with WhiteOak as a mutual fund house, and looking forward to many more interviews with you.
Yeah, it's my pleasure. Thank you for reaching out. Nice talking to you.